going to get going. And before we do that, just want to show you a quick disclaimer. I'm not going to read through everything, but please take note of this, and you can read it yourself in full at optionhotline.com on the disclaimer page. Please take note of this and just know that options always carry risk. Thanks, everybody. So with that, we're pumped to have Keith Harwood here this afternoon. He's going to be giving you guys some free education. Keith started his career back in the options pits of the SIBO, and as market technology changed, he successfully transitioned to off-floor trading by constructing directional portfolios using options and futures as a market maker, proprietary trader, and hedge fund trader. Keith founded his own company back in 2017 to share all of his expertise, and now he's ready to bring that expertise over here to Option Hotline, and we are really happy to have him. So today he's going to be talking with you guys about how to create game-winning home run trades, focusing on his home run swing trader program. Keith, are you with us? We're pumped to hear about this.
I am. Thank you, Natalie. I'm very excited to talk to you guys today.
Yeah, we're happy to have you here, and I'm excited to hear more about this product. So we definitely are raring to go. I want to go ahead and give you control. Okay, so I'm going to go ahead and make you the host, and you should be able to pull up your screen. While you're doing that, I want everyone who's listening, if you guys have questions during the presentation, put them in the chat or the Q&A box, and we'll try to get those over to Keith at the end of the presentation, time permitting. Okay, Keith, I can see your presentation. It looks wonderful, so you can take it away when you're ready.
Excellent. Thanks again, Natalie. So as Natalie mentioned, I'm going to walk you guys through my trade checklist today. And in particular, I'm talking about how to create these, what I call these game-winning home run trades. These are these big leverage trades that have absolutely explosive payout potential. So we're going to get through that. I know a lot of you guys have the trade checklist in front of you, and so I want to make sure that everybody's watching that as we go through, and that'll help get you guys set up for these big home run trades. All right, so the first thing I always do is I start with my disclosures as well. My lawyers say I have to do this. So as a reminder, all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. There's more here. I'm going to give you guys a moment to read through that and make sure that you fully understand these disclosures before we really get into the content today. All right, let's go through it. As Natalie mentioned, I started my career in the option pits of the SIBO back in 2005, and I spent over a year training to become a market maker on the floor. So I spent a lot of time really getting into the nuances of options. But I don't think the education really stops there. As you start getting into trading, you learn a lot more. As Malcolm Gladwell famously said, it takes about 10,000 hours to become an expert in the field. So if you think through that, 40 hours a week for 50 weeks a year, it's going to take 5 years to become an expert in a field. Fortunately, I've gotten 13 years now, so I feel like I've gotten to that level overall. And I've traded just about everything that can trade options on at this point. I traded equity options throughout the subprime crisis. I traded options on fixed income. I traded options on gold and silver when quantitative easing was really hot as a proprietary trader, managed a big book, futures options, ETF options as well. And then I got my MBA from the University of Chicago with honors and focused it really on econometrics, statistics, analytic finance, and entrepreneurship. So really trying to merge the analytical side that I had focused on early in my career with sort of a more entrepreneurial style that can really help me out with the educational stuff, because, you know, I've been teaching people how to trade really, you know, from the get-go, trying to help people learn more about trading options. And I just felt that this was a good opportunity for me to continue that. After I finished my MBA, I went on to a hedge fund, focused on commodities, very technical trading focused, and really honed in my skills on technical trading and technical analysis. So then I took that combined understanding of technical analysis and volatility analysis to create my own company that I could help other people learn about trading. That's what I brought with Option Hotline here, starting with them at their beginning, talking about ways that we can help others learn how to leverage the options market, because there's a lot of leverage and a lot of money to be made when the options market is used correctly, and a lot of money that can be lost when it's not. And so today, I'm going to talk through this 9-step trading checklist. So it's not impossible to figure it out. There's 9 steps. It's not a lot of steps, but each step requires a bit of review to make sure that we all understand exactly what we're doing. Okay. So I go through the process of finding a trade, the process of entering that trade. Once I've found it, what do I have to do in terms of the trade structure, the risk, the potential for the reward? Then I look at how to manage that risk throughout the trade, and then I finally get to my exit point. So that way we get the whole life cycle of a trade, from entry to exit and everything in between. And if you stay to the end, I'm going to give you guys a very special offer on my Home Run Swing Trader product. So I want you guys to make sure that you stay to the end and keep an eye out for that. Okay. So the very, very first thing I do is I look for a technical pattern. Some of you have probably seen me talk about rectangles or maybe even ascending triangles. And really what I'm looking for is a stock that had been trading in a range, had been forming some sort of technical pattern, and then breaks out of that pattern. Because once it moves out of that pattern, then the market can really start to reward somebody and punish somebody. So we get out of a rectangle and we break out to the upside. And now the long is finally being rewarded after, days or weeks of frustration, not really making any money being long, but not losing money. And the short was not really being rewarded nor being punished. Well, now the long is being rewarded and the short is being punished. And that's when the market has an opportunity to really put the foot on the gas. That creates that explosive potential. That creates that home run potential. Trading in the range is a different kind of strategy. But once you get out of that range and you get to that new kind of move where it's to the upside in this kind of setup or downside here, whether I'm going for a bullish or a bearish trade, I get a lot more explosive potential. Some of the other technical patterns that I look at are ascending triangles, descending triangles, bull flags where there's been a big move and then there's some profit taking before the next leg high, or a bear flag where, there's this, what we call a dead cat bounce, where the market recovers a little bit, maybe traps a few people on the long side, gets them this little confidence that the move is over, and then bam, just punishes them again. And these pennants that are really similar to bull flags and bear flags, all of these technical setups have a nuanced way to trade with the options, depending upon the way that the options market is really structured. But this is my first start. The way I get started is I look for a technical pattern. And what I'm looking for is something that I base this on the concept that I think I can make money in this stock. If I think I can make money in this stock, then I know I can probably do even better in the options because of my background in options analysis. So I get into this situation. I say I've got a technical setup and I've got a really nice potential for a stock trade. And then I define my stop loss, because risk is the most important side of a trade. Okay, nobody ever blew out an account by taking profits at the wrong level. But many, many people have blown out their accounts by not appropriately finding their risk management. So I always advocate that before you find your reward of a trade, you got to think about the risk. And so the risk of an equity trade is just the stop loss. What level am I getting out when things go wrong? So if the stock is trading in a rectangle, I've got this support at the bottom side of the rectangle if I'm getting long. So that's an obvious out. If this gets breached, it means now the long is getting punished instead of the short. Same thing in the rectangle here. If this resistance is taken out, it means now the short is being punished instead of the long. And I'm that person that's getting punished. Well, if I'm getting punished, I don't really want to stay in that trade. It's painful to stay in trades where I'm getting punished. And it's healthy to get out of those trades. And then I can move to the next trade that I'm going to hit a home run on instead. So I lose on this trade. I move to the next trade. I make a lot more money by being in the trades that are working and taking my mental capital and saying, you know what? I'm out of this bad trade and I don't have to think about it anymore. And by setting the stop loss, I know my risk before I enter my trade. So that's the basic setup if I'm doing this with the equity. But now that I know the potential for upside, how much money I could lose on the downside if I was in the stock, I start to look at the options market. There's a lot to the options market. It takes an inordinate amount of time to really learn the options market. But to start, one of the basic things I'll look at is the implied volatility level. So when I'm playing with a stock, which has more of a random walk behavior, and there's no real defined necessity for a stock to go down or up, it can go depending upon where the order flow is. Volatility actually has a mean reverting characteristic to it. And what I mean by that is when it gets really low, it oftentimes comes back higher. And when it gets too high, it automatically comes back lower. It's just the nature of the animal. So when things are moving too little, eventually they kind of break out as people stop trading them for that tight range. So then that liquidity decreases and then it goes more, it moves more. And when it's moving too much, market participants kind of pump the brakes. And then all of a sudden it slows down and the volatility comes back down. And so when I see a stock, so in this chart here, I have got the implied volatility level in the red and the realized volatility level in the blue. So this is one of the things I'll just look at immediately and say, wow, right here, this implied volatility was reasonably cheap relative to recent history, and the stocks were moving a lot. This is the S&P 500 right here. And right here, the implied volatility level was getting really low relative to history, but also stocks weren't really moving. Maybe that's creating a setup for me. I'm not sure yet. I have to dig a little deeper. And when the volatility gets up here towards 15, 16% with realized volatility low, that's telling me that something else from the market. And so I have to sit there and go through all of that along with the term structure and the skew and all of these other little nuanced things about options that I'm going to teach more once you guys subscribe to the Home Run Swing, because they just can't be covered in any short amount of time. It takes a long time to really get a grip on all of this stuff. Okay, but these are the tools that I use to generate that leverage in the options market, because that's where the leverage is finding out when options are mispriced relative to what we can see. So I'm looking for this mispricing in the options market. And so I do all my analysis and I start saying, okay, I know where implied volatility is. I know where the options market is giving me my edge. So now I want to start working on structuring a trade in the options instead of the stocks. So the first thing I have to do is now I have to say, well, what's my total risk tolerance? How much money am I willing to lose? Because if I don't know how much money I'm willing to lose, I don't know how big I can put on this trade. I've seen it from every level of trader where you will walk in and you will say, I'm going to double my account on this trade. And it's such a dangerous game to play, because the first thought is about how much money I'm going to make and not how much money I can afford to lose. Like I said before, I don't blow out my account making money. I blow out my account mismanaging my risk and taking too much risk. So let's say I want to risk 1% of my portfolio, which is kind of a standard number that a lot of people press for. Then I know that if this trade goes wrong, I'm only going to lose 1%. If I have a $100,000 account, I'll risk $1,000. If I have a $10,000 account, I'll risk $100. And that's it. Now, once I know what my option structure is, I know how I can make that risk tolerance work with my option structure. But when I'm getting set up at the beginning, I want to say, okay, here's my capital at risk. So if it's going to be 1%, then I say, okay, that's $1,000. Now, when I'm doing this, I also modify my sizing based upon how long I'm going to be in this trade. If an option is going to expire tomorrow, do I really want to take 1% risk overnight versus if an option expires in a year? The option that expires in a year has a lot more time to pay me, and it's going to take a lot longer to lose that money. So that's something else I have to factor in as I get into each of these trades. Okay, so all of this stuff comes back to then constructing the actual trade. There's more to it. I have to set my profit target on the trade. Where do I think the stock is going to go? All of this is about how to get that max leverage out of my trade. So with the stock market, a lot of people tend to assume that there's a normal distribution. What it means is that the stock kind of trades in this range, and 68% of the time, plus or minus a little decimal level, the stock will trade within a 1 standard deviation move of the mean, which is our starting price for the day. Now, in reality, the market has a little bit more of this negative skew. So what that means is that the market's most likely to stay here, but the highest probability move is up a little bit. And the concerning move is that downside. So we've got that fat tail. These moves to the downside are larger in magnitude, and the moves to the upside are higher in probability. But the point here that I'm getting at is when I get into one of these trades, and if I'm looking for a 1 standard deviation move over my time horizon, that gives me an initial price target. And if I set it with a 1 standard deviation move, I know that 1 in 3 of these trades is going to move more than that. And that's fine with me. because those are the trades that I'm making more money. And so I'm more worried then about managing my profit. But 2 out of 3 are going to make it to a standard deviation if I'm right. 2 out of 3 are going to make it to a standard deviation or less if I'm right. So I don't want to really reduce my probability too much. I want to have the odds in my favor of making sure I make money when I'm right. Because it's painful to have a stock go up and lose money because I got too excited about the potential for the move. Because I thought that this stock could move 2 or 3 standard deviations in a week, and it just doesn't always happen. It's rare to happen. A 2 standard deviation move is supposed to only happen once in a month. So that's another thing that I tend to look at as a short-term profit target. If I get a move of 2 standard deviations in a day, I'm taking money early more likely. Because I've gotten such a good move in my favor that I just like to ring the register there and reset my mentality. But that's beside the point. The initial profit target is set about that 1 standard deviation move over my time horizon. Okay, so now let's think through this. I've got my options landscape. I've got my maximum dollars of risk, and I've got my price target over a general trade duration. So then I just want to put together the trade that makes me the most money when I get to my price target in my time frame. And if I overshoot my price target, I'm going to make more money. Because that's the way I want to structure my trade, is to always make sure that if I overshoot, I make more money. There are ways to make trades that optimize my profit if I hit my price target, but lose money if I overshoot. And that's the worst thing I can do to myself. Because when I set up a trade, the stop loss, that's a hard line. That's drawn in sand. That is my risk. I am not going to deviate from that. But when I set up my profit target, that's a moving target based upon statistics. So I don't know if the stock's going to stop at a 1 standard deviation move, a 2 standard deviation move. Maybe the stock gets taken over and moves 7 standard deviations. I don't want to have a spot where that happens and I lose money. That should be the spot where I hit a grand slam and I am hooting and hollering and so excited about what I just did. So I have to sit there and figure out what tool to use. Am I using a hammer or a screwdriver? And how am I going to make the most money out of this setup? So that's all about that options analysis. Okay? The options analysis itself is a very complex process. So that's something that I'm going to work with all of you when you become subscribers to the Home Run Swing. Now, finally, I've got this structure. I know how much money I want to risk, and this is the simplest part of the game. I know the structure. I know what it costs to put on my trade. Let's say I just want to buy a call, and that call is 50 cents. Well, once I apply the 100 multiplier, that means $50 per contract. So if my total risk was, say, $1,000, and my call costs $50, I get to do it 20 times. And that's it. Once I've set the actual size, then I can actually start to think about what the potential return is if I hit my price target. And it better be better than my risk. Because when I'm making these trades, I'm not hitting 60%. I'm looking for the outsized return more so than the high probability move. That's how I get leverage, is by getting bigger moves, maybe a little less frequently. I'm not going to make money 80% of my trades. Because if I'm making money on 80% of my trades, I'm probably doing that in a de-levered fashion. If I'm leveraging up, I'm trading off some of that probability in exchange for multiples of the money I'm risking. I'm not looking to make double my money. I'm looking to make triple, quadruple my money, more. Okay? And so this, when I'm setting it up, I take the total amount of money I'm willing to risk, and I just divide that by the cost of the contract of the trade that I've structured that maximizes my return when I hit my price target, and makes more if I overshoot. And then if I look at that and I say, this looks good still. So I'm risking $50 and I think there's a chance that I'm going to make 200. That's a good risk reward profile for me. I'm happy with that. If my $50 trade is only going to make me $50 if all goes well, well, I'm going to put a big X through this trade and I'm going to go back to step 1 and find a new stock. Because there's a lot of stocks out there. And that's the fun part about trading, is I can look at hundreds of charts every day to find the trade that actually works. So now I've got this trade on, and I need to review and revise my stop loss from here going forward. How do I revise my stop loss? I just watch for new technical setups. So I look for, is there new support to my long trade? Is there a new technical setup forming? Did my bull flag turn into an ascending triangle? If so, the risk reward profile of this trade looks a little bit different. And more importantly, I need to adjust my stop loss so that it is higher than it was before, and I can make sure I don't give up the money that I've already been making. So the nature of a stop loss, it means that I'm not going to sell out a position at the maximum price if it's off of the stop loss as my trigger. There are ways I can maximize profit otherwise, but if I'm using a trailing stop, I will never actually sell the top tick. But as I'm watching all of this stuff, I want to make sure that I'm not leaving money on the table where something's been working and then I just get complacent and assume it's going to work forever. That's not how trading works. If I'm trading right, I'm watching stop losses and profit targets and always adjusting both. Takes a lot of time to set that all up as you're going through the trades. So it's important to have them ready for you every day. And then finally, I take my exit. So am I at my stop loss, whether for a profit or a loss? If so, it's time to get out. Has something changed? So we go back to that new resistance to my long. Is that my new stop? Is that my new profit taking level? Is there a new technical setup that's changing? Because guess what? If I set that trade I mentioned before where it was a bull flag and all of a sudden now it looks like an ascending triangle, well, my bull flag trade may be over. My ascending triangle may be just getting started and I'm back at step one. And I just go through the whole process again and define a brand new trade, even if it's in the same stock. I just start over and say, okay, I made all my money on my bull flag, new trade. I've got an ascending triangle and this is where volatility is. And this is where the term structure is. When volatility changes, I've got to change my trade structure as well. Back to step one. So I'm always going through the process. It's step 1 through step 9. When I hit the exit, if the technical pattern's not clear, I don't go back to step 1. If there's a new technical pattern that has emerged, I'm back to step 1, creating a brand new trade. Whew. So there's a lot there, right? Maybe the best way we can get through this is to start looking at some examples. But first, I'm going to introduce to you guys the Home Run Swing Trader so that you guys are aware of how I really put this in action. So the Home Run Swing Trader is my program that I'm the portfolio manager for here at Option Hotline. Go to optionhotline.com/homerun to find out more information. I'll keep that link up as we go through the examples, but this is the platform that these examples come from. So this will give you an idea of what kind of setup I'm looking for in this program, okay? First off, just a couple months ago, MNST, Monster Beverage Corporation, it set up a beautiful trade for me. So what's the first thing I do? I find a stock breaking out of a technical pattern. Well, I've highlighted here in yellow. This is the stock chart with candlesticks. It's chopping in this range between around 55 and 57.30. Well, on June 29th, traded through the June 25th high of 57.30. So step 1, I have a stock breaking out of a rectangle. Step 2, I find support. That's my stop loss. Okay. So if I'm just trading in the stock, I'm done. I have an entry and I have a stop, and then I'm just managing my stock from there on. But I want to hit a home run. I don't want to hit a single on this. So I went to the options market. And I said, okay, what's this options landscape look like? Well, so I said before, this red line is the implied volatility level. You can see here, it's about as low as it gets in Monster. This is about as cheap as the options volatility landscape gets for it. Maybe there's a little downside here, but the stock's been moving. Historical volatility is how much it's been moving. Implied volatility is how much it's expected to move in the future. So we've seen it moving. We've seen this not much cheaper. I'm thinking, okay, options are about as cheap as they get. And I'm thinking I'm probably going to end up long a call on this one. But I'll come back to that once I get through the term structure. Right now, I know that this is going to be an options trade now. So now I know it's an options trade. There's something here. There's an edge I can get out of the options market. Then I just define my capital risk. I say, okay, well, if I'm going to probably be long on a call, probably an out of the money call, and I'm going to risk, say, 1% of my capital, that's it. That's easy. It's 1%. If I have a $10,000 account, it's $100. If I have a $100,000 account, it's $1,000. I'm risking 1%. Maybe I'm a little more aggressive with my account and I say I'm going to risk 1.5% or 2%. Or maybe I'm a little bit more timid and I only want to risk 0.5%. It's okay. Because the reward is a multiple of that risk. So whatever my risk is, that's what I'm going to say is the amount of money I'm willing to lose. And then the reward will be given to me by the market after I've taken that level. And that's when I find out whether I hit my home run or not. So I go to step 5. Step 5 is set my price target. Okay. Well, we had this stock trading in this range. I think volatility is should be around 24%. So I calculate that one standard deviation move for about 3 weeks out. Why 3 weeks? I'll explain it later for those of you that subscribe. There's some reasons behind whether I would go 2 weeks, 3 weeks, 5 weeks, 7 weeks. All of these things will make a lot more sense to you once you subscribe. But in the meanwhile, the key here is that if I go in for 3 weeks and I set a target of $60.75 based upon the statistics, that now I need to figure out what makes me the most money on that move. So 3 weeks away is the July 20th expiry. And I found the $59 call for 55 cents. So if I just hit my price target, those calls go from 55 cents to $1.75. It's a little more than tripling my money. That sounds pretty good. I like that kind of return. If I overshoot, I make more. So I say, okay, I've constructed my trade. It's a long call. I know how much money I'm willing to risk. If it's $100, I'm basically two of these. Two of these calls will cost me $110. If I'm risking $1,000, it's 18. 18 calls would cost me $990. And then I'm in my trade and I'm managing it. So this is where the stock was when I got in, and this is what happened afterwards. So here's the stopping point of where I got in. And then over the course of the next few weeks, what do we see? I see the stock continuing to trade above that level and then generating new support levels. Well, as we continue to firm, I start to think that this previous resistance level may be good support. Then we get through a 200-day moving average. That looks like a pretty solid level of support. Then a couple of days before I close this, the stock reached $60.75, but it didn't look like the story was over. Some of the stuff that I did here, rather than just taking the money as soon as I reached that level, was to say, you know what? I have some decent support levels here that I can use that are just below where we're at right now. I can let this run a little longer. And then because I can do that, I can exit these calls for $2.74 instead of $1.75 and make a 400%, just under 400% return in just under 3 weeks. So we think about that. If I have a 400% return, it means if I risk $100, I'm making $400 on a $100 risk. That is a home run. That is what I'm looking for. I want home runs out of this. So this is knocking the ball out of the park and really, really enjoying the return that I get. Okay, so then I go to, let's say I'm done. Let's do another trade. Endocyte, a biotech stock. Who knows where it's going? You can see where it's coming from. Had some pretty low prices earlier. These moving averages are telling me that this stock used to trade in the 4s. And now it's up here at $13. That seems like a pretty risky stock to just go out and buy the stock. What happens if it just goes right back to 4 because this biotech isn't all that great after all? Well, the benefit I've got here with this market is I do have a pretty clean support line here. We've been chopping. This has got these kind of nice rectangle chop that I was talking about in the first one of the first slides. And you can see that we then took out the previous high, 1486, on June 11th. Okay, great. I got a new high in the stock. I'm ready again. I'm finding a stock that's breaking out of a rectangle, and I'm excited about the potential home run here. So I define my stop loss. It's down here below, just under 13 bucks. And I'm like, okay, great. If the stock goes below there, I want to be out. If it keeps going higher, I've got this potential for really good leverage if the options are cheap enough. Well, so what I saw here is that the options market was cheap relative to historical implied volatility. Maybe not relative to recent performance because the stock had traded in that tight range for a while. but past performance, we saw some really big volatility out of the stock when it really got exciting for people. Okay, so I'm looking at this, and again, I'm saying if implied volatility is low, I've got a potential to find an edge in the options market, and I'm excited. And again, I just define my capital risk. Again, I go back and I say, am I a 1% trade? Is this a 1.5% trade? Is this a 0.5% trade? And that tells me how much money I'm going to put in once I actually put together the trade. And I always do that first because then I don't get too excited about the reward potential and accidentally make the wrong trade size and convince myself that I can go bigger. So I want to set my max risk before I calculate the potential reward. Well, that's what I do there. And then I look at this again and I say, okay, well, if this stock moves at its historical level around 80%, oh man, in the next month, this stock should be able to get towards $19.50. That's a really nice move. Okay, so if I do this trade and I buy the July 20th $17 call for 60 cents and I just hit my price target, they're gonna be worth $2.50. That's a home run. I like that return. So again, I constructed the option trade that maximized my return if I hit my price target. And this was just a simple outright call because of the volatility landscape. And then I size my trade. So at 60 cents, if my risk is $1,000, I'm buying 16. That cost me $960. So a little bit less than that, less than $1,000. If my risk is $100, again, I have that question of whether I want to buy one or two, risk $60 or $120. It's a tough choice. It's all about the confidence and the potential there. So that's the thing that I always have to go through and make sure I'm comfortable with the risk. Am I going to feel so dejected that I have a difficult time trading if I lose my 60 cents on the number of contracts I've chosen? If $500 takes me out of my game and I can't trade anymore, then I've gotten too big in my head and I've gotten too big on the trade. And then what happened with Endosight, it didn't breach my stop loss, but it didn't explode until far later. So I had 3 weeks of almost no movement before the stock finally went. Now, I exited my calls for a loss on expiration. The stock closed 1733. Earlier in that day, I was able to get out for 45 cents. The problem I had here is that the stock finally broke out again here, and this would have been a great entry. You can see that that long rectangle lasted for so long, and maybe these options would have been really, really cheap at that point. But because it took so long for the move to happen, I didn't get the full move. It's okay. Sometimes you swing for the fences and you strike out, or you hit a fly ball right at an outfielder. You hit a grounder. Doesn't matter. Because if I set my stop loss at the beginning of a trade and I'm comfortable taking that loss, I can come back to the plate the next time and hit a home run and make up for it and more. Because remember what I said with MNST, I make 400% on that winner. That's the home run. So even if I lose 25% or 50% or even 100% of the money I put into this market on this trade, it gets more than offset when I hit a home run. So there's a stock that just didn't move enough to be a home run after all. But then I went to GoPro, another stock with sort of two different rectangles forming here. And when I saw this trade out of that first rectangle, I thought this can get pretty exciting. So again, step one, there's my entry. Step two, there's my stop. And I like this because if it continues to hold above there, I can really quickly raise my stop to the breakout point. That's nice for me. Step three, implied volatility doesn't get much cheaper than this in GoPro, guys, and the stock's moving. So this is great. I'm seeing a lot of leverage here. Define my capital risk again, 1%, 1.5%, 0.5%, depending upon how comfortable I am with my trade MO. Okay, now I've got this and I'm thinking to myself, this stock has potential to move, and I'm kind of liking the idea of it moving a little faster. So I shorten my time to expiration. I go 2 to 3 weeks and I set up a move, 6.5, 655. Okay, that's a pretty good move for 2 to 3 weeks. If I can get these June 22nd weekly calls for 12 cents and it gets there, again, I'm making 3-4 times the money I risked. It's a nice payout. I'm happy with that. So I go through and I say, I want the long call again. I like this setup. I say, okay, well, at 12 cents, if I'm risking $100, I can buy 8. If I'm risking $1,000, I can buy 82. You know, I can buy the number I've defined based upon step 4 when I define my max risk. Because the max risk then sets me up still to make a massive return when the stock moves. So I was just shy of that 655 level when I decided to exit at 51 cents. But we were getting real close there. Had this nice move, held above the support level there, did the secondary breakout. And after 2 days of that, I decided to go ahead and take the money because I had made 325% in just 8 days. That's a home run. So when I have those strikeouts before, it's okay because these home runs make up for them in multiples. So that's what I want to talk to you guys about a little bit more with the home run swing trader. Number one, I can make more money on one trade than in a whole month of income generating strategies. If I'm risking 1% of my account and I make 4%, if I have a 4x with that 5x return, I make 4% on my account in 1 day or 1 month or 3 weeks on one trade. I can make 400%. And I was only ever risking 1% of my account. If I'm doing one of those strategies where I'm selling put out of the money put spreads, well, that's great. I'm going to probably make money 70 or 80% of the time. But the amount of money I'm risking and technically is a lot larger than the amount of money I would have as my potential reward. So if I'm risking $300 to make $100, I have to size that trade so small that I have a tough time getting that 4, 5, 6% return every month doing that sort of strategy. Because when one trade goes wrong, I took away 3 or 4 trades worth of profit. I prefer the trade setup that when February 6th happens, I'm sitting with a ton of cash on the sideline. Because if I'm putting on 10 trades, that's only 10% of my account. So I'm 90% cash. If I'm putting on 20 trades at 1%, I'm 80% cash. I have a lot of cash so that when the market has a major blowout to the downside, and everybody else is scrambling that was doing these premium collecting strategies and they're just trying to figure out if they just blew out their account, I'm ready to jump on the next opportunity, up, down, whatever way that the market's setting up, I'm there ready to play. Everybody else is licking their wounds and trying to figure out how to fund a new account because they just blew out because they're using margin with those short option strategies. It gets really painful there. And on top of all of this, instead of having to be right 2/3 or 80% of the time, I only have to actually be right about 1/3 of the time to make money with this system. Because when I win, I'm doing a little better than tripling my money. And when I'm wrong, even if I lost 100% of my capital every time I was wrong, tripling my account on the times I'm right means I only have to be right 1/3 of the time. And guess what? I'm right more than that. So that's how that works. If I'm right more than 1/3 of the time and I'm making more than triple my money on average when I'm right, that's a winner. I don't have to sit there and stress every time I get a loser because I'm going to come up the next time at bat and I'm going to hit a home run. So with that kind of system, it's a lot less stress. And it's a lot more exciting. And I retail this trade program for $199 a month. Remember those trade results we talked about earlier? MNST, 400%. GoPro, 325%. So when I'm right on one of those trades, it pays for a month, even on one contract. Well, one contract of MNST, a couple contracts from GoPro. And in this system, I show you guys where I'm getting in and I tell you about it immediately. So you can learn from why I'm getting in and make your own decision. And if you decide that you want to make the same trade as I do and you hit the home run with me, you paid for the system. These people that oftentimes send out these results, send out their ideas a little bit delayed. Kind of wait for a little bit more information, or they type up a generalization, a reason for all of this stuff, and you miss the trade. Because if a trade happens at 245, by the time it gets to you guys, it's after the market close and the stock can gap overnight. I've seen it way too many times in the last few months in particular. These real-time actionable trade concepts are incredibly important. Real-time alerts. But I'll tell you what, I think that this on its own, just the trade alerts are worth a lot. But the point for all of this is the education. I want you guys to learn. I can give you a fish and you can eat for a day. I can teach you how to fish and you can eat for a lifetime. We're on a journey for 10,000 hours so you guys can be an expert in options, right? Well, every month I'll do an Ask Me Anything session. You can literally ask me anything you want about trading, about risk management, about portfolio management, about home run swing, about the next move in the market, whatever you want to hear from a guy with a greater than a decade of experience looking at stocks and charts and commodities and all of the market all day, every day. And I normally charge you guys $500 an hour for consulting. I'll include that for free. So you get that hour with me for free on top of the trade alerts. And more courses. I want you guys to learn. So I will teach you more about why and how I trade certain technical setups, why and how I trade certain option market setups. This stuff took me years to figure out and to perfect. There's only so much that I was taught at the beginning, and a lot of this stuff is stuff that I figured out after years of experience. Well, let me help you. You don't have to go through years of experience to figure out how and why I trade certain technical setups and how and why I trade certain option setups, because I can tell you how to hit a home run given the pitch from the market. You got to take a different approach when somebody's throwing you a curveball than when they're throwing a fastball down the middle. These courses are almost priceless. I mean, they're $1,000 a piece normally. Again, I'll throw these in for free. So you guys get that education, you get that learning, you get to learn how to trade options and technical setups by signing up for the program. And you get them for free. That's all for $199 a month. Okay, so let's recap some of the examples earlier. MNST, that was a trade from Home Run Swing, and that made $219 per contract. So if I risk $55 on that one trade, I make $219. $219 is greater than $199. So that's already paid for that. So in our journey towards 10,000 hours of education, I can either just spend money on all of the education, or I can make money. Wouldn't you rather make money while learning than spending money while learning? And on top of that, I throw in the education. I throw in the Ask Me Anything sessions. I throw in the monthly webinars. You got all that education so you can figure out how and why to identify these setups. Because I'll tell you right now, I identify a lot of trading setups, but I don't identify all of them. So you will be able to find the trading setups yourself. The total value of that, the consulting hour, the Ask Me Anything, the monthly webinars, the Home Run Swing Trader. And remember, it's all real-time trade alerts, which is priceless. That's all worth $16.99, and you're getting it for $199 a month. That's 88% off. So I always talk about how I'm looking for setups that are on sale. This is a setup that's on sale. I look forward to having you all on as Home Run Swing Trader members as soon as you finish listening to this webinar. Thank you, guys. Wait, I do have one more for you. Okay, you guys are going to be charter members. So instead of $199 a month, you can get it for $99 a month for the lifetime of your membership. So instead of paying $199 per month, you pay $99 a month forever until you decide that you no longer need this because you're so good at options trading without me. You got to go to optionhotline.com/charter and enter the promo code charter to get that special discount. So that's where I'm really giving you guys a super discount. It's still all the same information. You're still getting that $16.99 of value. You're just getting it 94% off now instead of 88% off. Thank you guys for attending, and I'm excited to have you all on Home Run Swing starting tomorrow morning, bright and early.
Thank you, Keith.
Thanks, Natalie.
That was a great presentation. You guys take note, go visit optionhotline.com on Keith's page, get some more information and reach out to us with any questions. Keith, pleasure to have you, and we'll have you back soon for another educational webinar. Thanks everyone for attending. Have a good rest of your night.